Next up in line, we have our second panel, and this is about how to get staking ready for institutional adoption. Our moderator will be Jim McDonald, co-founder and CTO of Attestant, and our panelists will be Andreas Dittrich, Managing Director of Finoa Consensus Services, Laszlo Szabo, CEO and co-founder of Kiln Finance, Philip Pieper, CEO and co-founder of Swarm, and Alia Das Gupta, Senior Vice President, Business Development at Signum. We will have a short break for the chairs here, and then it kicks off. Thank you.
Good morning, everyone. Thank you for attending. So we're going to spend a little bit of time talking about institutional staking. When we have looked at staking over time, we've seen that there have been a number of waves. Early on, we saw the technical people and the true believers. These were the people who came in and really knew that this stuff would work before there was any real proof behind it. The second wave we started to see were the financial people, the people who actually went, yep, okay, I wanted to wait to see that it worked, but now it does. That's fantastic. But these guys were still very much in the crypto space. What we are looking at now is a third wave, and the third wave is institutions. So one of the things that we want to explore today is what do the institutions want from staking? What have we got at the moment? What are their barriers to entry? And how can we help them to actually come into the staking industry and obviously bring that third wave of staking with them? So one of the first questions is going to be who are the target markets? Who's out there who wants to stake and wants to use institutions but currently are not in the game? So Alia, I mean, one of those groups are the crypto natives. And what do we know about them?
Sorry, so the question is, sorry, good morning, everyone. The audio on the stage is a little bit...
Yeah. So, I mean, who are the crypto natives and what do they want to do staking?
So, I come from Signum Bank in Switzerland, and a large part of the thesis for us at Signum is looking at sort of both sides of the ecosystem. So people who, are from the crypto world and need access to traditional finance, but also the, let's say, the normies who are interested to engage with the crypto sphere. And for all of these guys who want to invest in crypto, getting them into the space where they can also start to participate in the ecosystem beyond just, let's say, holding assets and custodizing their assets somewhere. This has a little bit been why and how Signum's entry into staking has been so firm and fast. But over on the crypto native side, I think that there's a lot more space out there for maybe non-custodial staking solutions, and I think that's a lot of what we have here on the panel today as well. I don't know, what do you guys think?
Great. I mean, so crypto natives, obviously, as you say, they're out there, they've got crypto, that's great. What about if we look then at maybe the more traditional investors, the people who have maybe a high net worth at the moment and are now interested in coming into this space but perhaps don't really understand crypto at all? I mean, Philip, maybe you can talk to that.
Yeah, let me maybe just add to what you just said. I think I would say there are three different motivations for institutions to get involved at this point in time. I think, first of all, there's a common understanding, economically speaking, that actually the crypto assets actually with staking become very attractive. So it's basically own ETH plus. And so it becomes really crucial to actually, if you engage in the belief of actually your crypto assets being valid and you want to actually engage as a fund or as a institution, then it actually almost doesn't make any sense to actually own the asset straight, but you actually have to have a valid stack of solution that can service you with the plus portion of it, right? The second portion, I think we have to realize, and maybe not everyone recognizes this yet, but a lot of the infrastructure that we create today is going to be used for asset tokenization and for real-world assets. And if that's the case, and big question is when is that happening and at what pace that is happening. The institutions want a piece of that infrastructure. They want to show the commitment to be part of it, to influence where that goes. And that needs them to actually be able to buy into that without the complexity of actually knowing what a wallet is or knowing what the staking process is, but be able to sort of work on the same abstraction layers that they're used to actually in their current markets, where a lot of the service providers actually work in their direction. So you have to meet them where they are.
Okay, great. So obviously there are some areas out there that we can chat to in a minute about that. If we're looking at maybe some of the other people who are looking to stake, though, I mean, Andreas, one of the people that I've certainly heard a lot about, my kids and their friends want to get into crypto. So the younger entrants who maybe don't have any money at the moment, but will be having money in the future, are they an option for institutional stakers?
Probably those are not institutional stakers then, but and also I think the question is a different one in that case, because if you're thinking 20, 40, 50 years in the future of value creation, you probably shouldn't have all in crypto, right? You have to think more about what's the percentage of high-risk assets in your portfolio that you then want to grow. And then of course for those assets, if it's crypto assets, staking, if it's proof of stake assets, you need to consider, right? So having said that, focusing on the staking part, looking 20, 40 years in the future with the current staking implementations wouldn't work probably. We saw that in Felix's presentation before. Staking implementations are still bootstrapping. Most of that is just inflation tokenizations. That's not going to hold for 5 to 10 years, let alone even longer, right? Ethereum is already a bit different because it's more mature, but again, staking mechanisms will change. So if you're focusing on long-term growth, staking is not your concern, I think, at the moment. Yeah. That is more for short-term investors, short-term in the sense like 5 years maybe, 5 years horizon. Institutional investors like VCs, the foundations, you need to look 3 to 5 to 8 years, and then it makes a ton of sense, of course, to invest in your network and to support your network by staking your tokens. Okay.
So we should probably get the kids to stick to NFTs, right? Okay. So one other area is traditional corporations. I mean, Laszlo, we've talked about individuals at various stages, but there's a lot of corporates out there who are looking to maybe put crypto on their balance sheet, but have no ability to do so. Is that something where institutions you think may be able to help?
Right. I mean, first of all, I'm the co-founder and CEO of Kiln, so we build staking products for institutions, right? And yeah, I mean, institutions, they're not dumb at the end of the day. They're searching for high rewards and low risk. And ultimately, that's something you can find in staking. Instead of like other DeFi protocols or even lending, you don't have counterparty risk, or at least your counterparty is the protocol. So if you stake if you hold a token, you have to, you better stake your assets, earning the inflation, or you're going to be inflated as an institution and earning the fees and the MEV. Yeah. So this being said, a lot of institutions holding their assets in B2B custodian today. So you name them: Copper, Fireblocks, BitGo. If they hold stakeable assets, they're willing to stake them today. Specifically because it's the bear market. These assets usually moves much less than 12 months ago. And now if they're still holding their position, they better stake these assets, yes.
Okay. So it sounds like we've got a market out there for institutions to adopt. So the obvious question is, why aren't they? What are some of these barriers that are out there that mean that an institution might look at staking, might look at crypto and say, yeah, we'd really like to do this, but we can't at the moment? I mean, that's what you're talking about, obviously, Kiln and what they do there. So what about things like simply technical ability? I mean, these are financial guys. These are institutions that do financial work, and they're not technical people. So is that technical ability to stake a significant barrier for them entering?
Yeah, that's a very good question. then it really depends on the protocol. But if you look at what could be, or I mean, already is by a factor of 2, I think, compared to the second market of staking, but it will be maybe, I don't know, 50% of the staking market tomorrow, Ethereum, right? If you look at Ethereum, it's still very complex to stake on ETH. It's not one transaction. It's batches of 32 ETH. The rewards go 100% to one wallet. So if you're working with custodians, if you're working with a staking provider, there's no simple way for them to take a commission out of it. So yeah, I mean, there's a lot of things that remain to be done. And we've built, for example, a product that allows any institutions to stake any amount of ETH. Could be batches of 32 in one transaction, and automates the rewards from a B2B custodian. So I think that's one. Second is, you know, if you stake on Ethereum, if you stay on this example, you're liquid until when? That's the big question. So, and you know that, Jim, as well, was at Estent. Some institutions took their risk, but some just said, okay, I'm not going to stake all my ETH because I want to keep some of these ETH liquid. So that's a big pain point. I think the merge made that kind of easier for them to stake because the merge decreased a little bit the risk and obviously got us closer to when withdrawal enabled. But you know, liquid staking projects for retail or institutions are great. Or at least these institutions are really interested about using them. First of all, for liquidity, and then also for the composability of getting the yield and still earning DeFi yields on top of that.
Okay. So, regardless of if an institution looks to use a liquid token or they wish to stake a cryptocurrency natively, there's a lot of concern, I think, in the industry about custody. Custody is one of those problems that they face an awful lot. They understand how to hold cash, they understand how to hold stocks, they don't necessarily understand how to hold crypto. I mean, Andreas, would you say that's something that the industry really needs to address?
Well, Finoa is an institutional-grade custodian, right? So this is what we have to deal with. And
by the way, I forgot to mention Finoa. I'm just
don't worry.
Sorry for that, man.
Let's say you invest in a proof of stake asset and your risk analysis says, yes, you want to stake that. Because Laszlo just said it right. If you look at Ethereum, we have 12% of Ethereum staked. That's not a lot. And that includes all the Lido stakers, for example. And why is that? Because the risk-reward ratio is simply too high. It's like flipping so that most people do not stake. The reward simply is not high enough to warrant the risk. Now, but let's move to those institutional investors that invest in new proof-of-stake networks. And usually, their risk appetite is such that they do want to stake. Now, they usually have big bags. We're talking about institutions, right? So you're talking about the tens, maybe hundreds of millions in assets that they're holding. They simply do need a custodian because you don't want to take that risk. I mean, it depends on the institution. If you are on the VC side of things, almost all of them work together with regulated custodians, qualified custodians in the US, such as Finoa, for example. And foundations do some self-custody, but in parts they also move to custodians. You simply do not want to have the risk of messing up stuff. And custody is way harder than staking in that case, because with staking you can't lose much. You're just delegating. You might be missing out on rewards if you do stuff wrong. If you delegate to the wrong staking provider, yes, there is slashing, but usually that is being neglected. So with staking you can't do much wrong. With custody you can, because you can just lose your tokens by doing something wrong. So yes, custody is crucial for new proof-of-stake ecosystems, because they need custodians, a batch of custodians, usually not only one, for their investors, for the foundations, for all the big token holders. And then those custodians need to enable staking for those investors. That is expected by now, that from a regulated qualified custodian, you're able to delegate your assets to a trusted staking provider.
Okay. So having custody is obviously a very important thing, like you say, having a service that can do that. One of the other problems that we commonly see out there is fiat volatility. I think everyone's aware, you mentioned someone might have tens to hundreds of millions. That probably depends what day they look at the markets to find out how much they have. How do we handle, Philip, for you maybe, how do we handle things like crypto volatility? How do we handle the accounting of that even? Because it's an incredibly dynamic asset. We have changes in the base price, we have rewards coming in due to staking. How do we actually address all of those different factors and manage them for institutions?
So let's start with the bottom stack. First of all, we talked a little bit about node operation, which is already complicated enough. Custody is the next level where institutions need to abstract that away. So we're moving up the abstraction layer in this case. And data, which moves into actually how to account for it, is one of the most crucial pieces that I think is misunderstood today as being the truth that is out there. So I always laugh when I see regulatory filings that quote CoinMarketCap as a de facto, source of truth here. And the financial markets have an even higher standard, like the ESMA in Europe has the BMR standard, which is a license that you have to acquire after 18 months. You can probably get it if you get through the process. That ensures that you have enough data, you have enough fail-safe, you have enough neutrality, you actually are a competent provider into the infrastructure of institutions. And we as a staking industry are far from that. And so when you think about managing volatility, knowing what volatility you're dealing with is the start. But then the question is, do you actually abstract the volatility away in the crypto world, or do you actually move into the financial market world? Do you actually move into the Bloomberg world to then actually have financial engineers on the other side abstract it away? And we are convinced that the latter is actually going to make it happen, because otherwise you have another set of unlicensed players in the market making space that try to solve that for you, and that doesn't work for a lot of institutions.
And I think there was a really important point in there as well, which is a follow-on maybe earlier for you, was what is the regulatory space? It seems certainly from my point of view that it's largely undefined. Sometimes it's a bit positive, sometimes a bit negative, sometimes it's friendly, sometimes it's hostile. That seems to be a massive barrier, because any large financial institution is not going to enjoy the fact that there is a huge amount of regulatory uncertainty out there.
Yeah, I think absolutely. That is very much the reason we haven't seen the mass inflow from the institutional side into the staking universe, because fundamentally trying to regulate crypto, a decentralized asset class, by centralized entities in different parts of the world, that's just an oxymoron in and of itself. So, I mean, I'm based in Switzerland, and Switzerland's been arguably amongst the front runners in terms of regulating digital assets and creating frameworks that enable some sort of certainty around the regulation of digital assets. And I think that's what sort of sets Switzerland apart a little bit as a jurisdiction for crypto. But even when we're working with different institutions, I mean, now with the sort of new questions arising around maybe Ethereum becoming a security, what Gary Gensler was saying, and it's not an unsolvable problem, but it's certainly not a problem that we are very close to solving at this point of time. I don't know if you...
Yeah, I mean, I'm pretty sure you have something to say about it, and maybe Philip as well, but yeah, I mean, first of all, we have to say that staking is not custody. So it shouldn't be regulated as such. There's the risk of slashing, but technically we cannot steal the funds of our customers or retail. We can burn them, which is slightly different. So I don't know if there's any, maybe Philip, you can talk about the US perspective, but we talking to the AMF, the French authorities, because we based in Paris, and they launched the PSAN, Prestataire Service d'Actifs Numériques, so they have a custody license today, they have an on-ramp license today, but they don't have a staking one, just because it took them a lot of time to understand just the concept of staking, non-custodial staking, the fact that, again, we don't owe the assets of our customers, but we can still burn a big part of it. So we think maybe in 12 or 18 months, they might be in France, and then maybe globally in Europe via MiCA, a license for staking and staking providers. And obviously, as you mentioned, Aliyah, these institutions, the TradFi guys, the large banks, the traditional market makers, they're waiting for these licenses to come to flow a lot of their assets into crypto first, then getting the best B2B custodian in the market and stake them.
Yeah, maybe one addition from the regulatory perspective. This should not turn into a regulatory panel, so I'll be short on this one. I think it's fair to say that America has a lot of confusion in the market about like what these things are, and I think there's still a lot of work to be done on the regulatory side to actually see clear. So this was one of the reasons why I personally moved from America to Europe, because it was unclear, and it remains unclear. And I would say in the Swiss, as well as in the German and now in the wider European scene, I think we have a lot of clarity that actually has been astounding how much it's been reconfirmed over time, which means, and this is not just the financial market perspective, but it's also the taxation perspective. And we were very excited in Germany to see that actually with the taxation that actually was first indicated 2 years, now it's been reaffirmed after the administration change, that actually staking has specifically gotten like a place in that heart of the tax directive, where it's basically said that it doesn't constitute a transaction where you basically have to then actually tax it as a transaction, but it actually is being rewarded as a network reward, and there's no counterparty on their side. So I think we have much more clarity than actually the broader market is wanting to assume right now. Now the unfortunate situation is you need licensed player to service that. That is basically the outcome of the regulation. But if you can deal with it, it actually creates a lot of clarity for the consumer, whether that's a retail consumer or institutional consumer, to engage in this space.
I completely agree with Philip, by the way, and let's not make this a regulatory panel. But for institutions that are staking, the regulatory uncertainty that we have at the moment around staking is bad. And just yesterday, I had a longer discussion with a customer of ours who has been deliberately unstaking assets because of regulatory uncertainty, because they weren't sure in this case about what's it, UBTI, right? So I don't know the exact meaning of the acronym, but basically it's an income tax issue of unrelated business. So usually you're exempt from taxes, but by earning staking rewards, by delegating your assets and earning, you might be subject of this tax, and it's simply not clear. We have the same situation in Germany and in other countries where staking still is not regulated. And another interesting tidbit about this is, I mean, lots of staking providers in here, probably in the audience, right? Every single one of you thinks you're an IT service provider for a stakeholder, right? You're providing a technical service to the network, of course, and you're using tokens for that are being delegated to you. Now, from a tax perspective, there is a strong argument to make to say that, well, it's not you providing a service to the stakeholder, a technical service, it's the stakeholder lending you tokens, providing a lending service to you. Every single contract, especially in the institutional space between stakeholders and node operators, is structured differently the other way around. What's right? We don't know, right? And the thing is, we need clarity. Until we have clarity here, and that's the thing about, I completely agree, by the way, about regulation. It's a beast, right? It's good and bad as well, but without that clarity, you won't have enough token holders staking. We need, especially the big token holders staking, to secure our networks.
Cool, thank you, folks. So it sounds like, again, we're in this situation where there's a lot of work that needs to be done on the regulatory side, for example. But one of the questions that we'd like to think about is, what can we do to help? How can we help institutions onboarding with crypto? So I think, Andreas, you mentioned it earlier, can custodians become staking services and offer those services directly to institutions? Or would they need to go via the institution's customers themselves? And if so, is that a case of partnering with institutions, or can you work directly with them and be single customers of theirs?
Yes, they can. Of course, because we're doing it, Kraken is doing it, Binance is doing it, Coinbase is everybody is doing it. Now the question is how you structure that, whether that's a separate legal entity or not. But from a product perspective, from a customer perspective, it is simply expected that you're allowed to stake from secure custody. John was making a great point for retail users. They just want to click a stake button from the Binance wallet and not care about it. For institutions, it's usually a bit more complex, but the main story is the same. Institutional stakers expect to stake from custody, and so it's a business strategic decision for us as Finoa. For example, if we support early stage networks, you don't have a lot of trustworthy staking providers out there maybe, so run the nodes yourselves. At the same time, from the customer's perspective, we want to give our customers choice. So you can pick, for example, Chorus One, you can pick Blockdaemon, you can pick Figment. Well, why not pick Finoa as well? And then the customer can choose which one is the trustworthy staking provider they want to delegate to, or what basically their distribution among staking providers is. So I think it makes it a lot of sense, and if you look at Kraken and the likes, they usually have one specific company that they offer to their customers to stake with. Well, if you trust Kraken, if you trust Staked, that's a good combination for you. We go the other, like we extend this, and I think that's the better way from a customer perspective, because we offer our own nodes. If you want to trust Finoa, yeah, delegate to us. Of course, we're happy to get your assets, but if you need to delegate to other staking providers, we support that as well. So, yeah, the problem is always, I mean, it's always about decentralization, even in the institutional space. So yes, by having a custodian and staking from a custody wallet, yes, of course, there is a centralized element, but you can, as I said, you can open it up by offering more operators in the mix.
Yeah, I mean, if I can add something to that, as yeah, I think for the institutional staking world in the next 5 to 10 years is going to be more and more multi-staking providers, yeah. Right? I'm not sure there will be thousands of staking providers, even if some say validators are commodities, because you need to have a critical size for these institutions to trust you. You need to have history on chain, for example, Attestant or we do on the Beacon chain. But if you're a custodian and you have plenty of clients that are willing to stake, there's many reasons why they would like to use multiple providers or spread the risk. That's one reason. Enable decentralization. That's another reason. There might be also geographical reason. Where do you run the nodes? When do you run the validators? And yeah, and that's one of the reasons why we run our validators, but we're also building aggregation layer for custodians or exchanges on Ethereum and other protocols to make sure they can spread their stake easily, programmatically, and also get the right data, right? I think you mentioned it earlier. And that's a pain point that staking rewards is trying to solve as well. The data in staking today is quite poor. It's very far from what traditional finance and traditional markets are. Often you get the wrong data on many of these protocols. It's hard to do reporting, and these institutions are willing to have very precise reporting every day, every week, or every month.
Every second.
Sorry?
Every second.
Every second, every block, depending on the protocol.
So a question on that then. Obviously, we're possibly a little bit biased here as we're generally in and around the staking services, but would there be any reason for institutions to actually run their own staking services, run their own staking service for their customers as opposed to sort of a general public one?
So let me just intersect, because I think we're pretending as if there's one need space for the institutions. And institutions are like segmented in different areas with different risk profiles, with different compliance requirements, with different abilities from a workflow perspective, and size and mandate, right? And I think we just have to recognize that right now the institutions that are really tangibly doing the staking out of a custody environment are not the big guys that are basically sort of going to come to do their other work. And if you look at Fidelity, et cetera, they're not yet even close to running their own nodes, or even don't want to, or even don't have the mandate to do so. And that has a lot to do with the further abstraction of the layers that then take the foundational components, whether that's the node operators or the custody environments or the liquid staking environments, which, by the way, is a hard thing for them to engage in Lido because they don't know what the counterparty on the other side is, right? So we'll see much more abstraction into those higher levels happen, which ultimately leads to someone saying, okay, I'm buying, I don't know, all different staking node assets on the Bloomberg terminal, and I'm going to make a derivative of an index as a result of it.
And I couldn't agree more with Philip. The space is very diverse. And you see VCs running their own nodes if they choose to do so, if they have the expertise to do so. You see a lot of foundations running parts of, I mean, especially when bootstrapping a network, running parts of the nodes. You have corporations, I think we have Deutsche Telekom here in the room, traditional corporations that do run staking nodes, right? So again, it's your personal choice as an institution whether you do run nodes or not. Yeah, but most of them in the most of them in the institutional space choose not to do so, and that's if you see the value staked. The vast majority of that is being delegated to professional node operators that specialize on that type of business. Again, that's a risk management result.
It also comes down a lot to the technical ability in each place, right? Like learning to upskill and having that kind of technical talent in-house to be able to manage it. So even at Sygnum, we offer several staking services, but we run the nodes ourselves for some of these, but we also outsource the others. And even as a native crypto bank that's, very dedicated to the space, if we choose to find a simpler solution outside, I can only imagine that someone whose core business is not crypto would also think to do the same thing. But to your point of the levels of abstraction, it's how many of the people that you work with are looking for that one-touch solution, like press this button to stake. And you were talking about even finding different options as staking providers. Now, I know a lot of our clients, the people who come from the non-crypto side of things, for example, I don't think they necessarily fully understand the need for different providers or what they gain from staking with you versus with you versus with you. And they come to Sygnum because they don't want to make that decision at all. So it's a complex one of finding that sort of sweet spot of what you can offer and then also addressing the needs of your specific client base.
So just on this, we've heard Philip and Leo, you've both mentioned this idea of abstracting, moving away from what we have at the moment and we think of technically as staking. Should we be offering institutions financial products? Should we actually have some kind of wrapper, a derivative, indexes, baskets, all of those kind of things that we can use instead, just to simplify that whole process and quite frankly stop talking our language and start talking the language of both the institutions and the people who invest with them? Aliyah, do you want to start with that?
500% agree. I think that's definitely where the industry will go. I think we're super at the early stage of things. I mean, a lot of being able to create this wrapper, create these sort of derivative products is really from the regulatory and certainty that we were talking about before. So being able to kind of find a taxation solution for this, how to kind of find the returns, how to find the data of different products that you're staking, aggregating all of that into a single easy to buy product, ideally on your regular stock exchange, that is where we will go. And I think we will go there because of the sort of rewards that come out of the space, which is still hard to see in the traditional finance space. But yeah, the journey there is an arduous one.
Yeah, I think for the entire space, it's a rewarding exercise, right? Because, like I said at the beginning, we want these other consumer groups to come in and actually benefit from the blockchain. And in order to say that they're in it, they actually want that kind of staking ability because they want to participate in the infrastructure. But there's like all these small intricacies that are really hard to overcome still. Like, for example, ideally you have an ETH staked asset not denominated in fiat, but denominated in Ether, because that then shows actually what the difference to Ether is, right? And so you need actually a securitization infrastructure that is able to consume that, and you need to convince the regulators and the market infrastructure providers, et cetera, that this is something that actually has a certain benefit because it's like, I don't know, gold being sort of described in gold, and it's nothing different. And I think that work is being done, but the reward is going to be pretty high because the ease of actually then putting not just money in, but actually putting commitment into the space is incredibly important.
Do you want to add to that, Laszlo?
Yeah, I mean, you also participate in Stakewise, so I'm pretty sure you can talk about derivatives on top of staking, but yeah, it's obviously a big demand today. I think mentioned earlier, first of all, it brings liquidity, right? On Ethereum, these assets are quite unliquid today, and these institutions, they're willing to have a liquid assets, or even retail, obviously. We've seen Lido and the growth of Lido. We've built Alluvio, which is a consortium with exchanges and one of our largest competitors in the institutional space, because we thought, okay, this is not this liquid staking token or receipt token for institutions does not need to be centralized. It has to be decentralized. It has to be a DAO. It has to be a consortium of different participants and maybe more retail in the future. And yes, to bring instant liquidity, to bring KYC for these institutions, at least in the pool, then the receipt token is pegged to permissionless DeFi, so you can still gather the power of DeFi liquidity. And and you can use this receipt token on Aave, on Compound, on Curve, so that you have the staking yield plus, at your risk, obviously higher yields depending on your strategy. So these are very demanded assets from retail. Obviously, we've seen the amazing growth and success of Lido, and institutions were willing to have their own standards and own protocol. That's why we're building Alluvio. Do you want to say anything about that?
I think liquid staking obviously is a huge topic in the institutional space. And for example, yeah, we are supporting Stakewise. There's no panel without an announcement. Just an hour ago, we announced our support for Metapool, which is the biggest liquid staking pool on Near. Yes, we do dip our toes into the water, but to be honest, I don't see very strong demand for liquid staking from institutional investors just yet. Simply because there are lots of uncertainties around liquid staking. And we saw that with Lido just a few months ago, let two bigger players exit and have problems with Celsius and Three Arrows Capital. And suddenly you see huge discount on the value of staked ETH from Lido, which has by far most liquidity of any liquid staking pool out there. So if you look institutions, you have 3 or 4 of them exiting, suddenly liquidity becomes a huge problem. You have smart contract risk, you have all sorts of risk because, and again, you're adding abstraction layers on top, which stack risk. And I think that is simply not well understood at the moment. And although I think the space is moving towards liquid staking will be, abundant on every proof of stake network. There's just no way around it. Just to get exactly the goodies that you mentioned, well, we need to solve a lot of problems until we get there, right? At the moment, I think this is still a playground and we need to try things out to see how this can then work for all stakeholders as a whole, and especially including big institutions. Also, maybe adding to that, I see a lot of hesitancy from talking about liquidity, from professional liquidity providers for liquid staking pools, and you need those in the game to make it work for institutions.
So it sounds like we have a lot of work to do as well, which is good, right? Because it's good that we know that we can build things to help institutions to get onboarded. We are running up against time, but what I'd like to do just to wrap up is maybe each of you spend 30 seconds saying where you think you're going to see big breakthroughs as institutions come in over the next 6 months to a year. Just Leah, shall we start with you?
Sure. I mean, the next 6 months is a very ambitious time frame. But I think what we've seen now in this bear market is the sort of movement by institutions into the space, which sort of, I don't think anyone's asking the question anymore about, is this the end, or are we seeing the end of crypto or the death of crypto and so on. With all the institutions coming in, it's only, I think, accelerating the journey towards creating more let's say simplified assets that can be easier for them to understand and to invest in. Over the next 6 months, I think we'll see more of these sorts of movements of institutions entering the space, and ideally creating more data frameworks, like what Staking Rewards is doing actually. It's fantastic to help understand the different layers of complexity in the staking space between different assets, and then enabling the creation of investment theses that can match their portfolio directions, basically.
Thank you. Philip?
So I think whoever's been at Breakpoint this past week has seen that the conference was 3 times bigger than last year. And 80–90% was developers being there. And I think the same applies to the efforts on the institutional side. None of the institutions have stopped to develop in this space. None of them have stopped the strategic initiatives to actually get their foundational infrastructure in place, either as a white label or as their own stack. And that always starts with both, custody, as well as, things that are close to the banking stack. So for example, like how do I tokenize a digital version of money, whether that's CDBCs or not, that doesn't really matter, right? So once they are there, they need products to put that into that infrastructure. So at the time when they are ready, we as an industry need to be ready to have that ready, have our ducks in order, have our solidity of the data space ready to actually know exactly what the stack is from a trust level perspective and from a regulatory purview, and then it slides in. And that's a massive tuck-in, because they then at that point in time no longer have to do a lot of technical investigation or move themselves towards this, which takes an ordinate, huge amount of work more than if we do it for them. So that's going to happen in the next 12 months for sure.
Sounds very exciting. Laszlo, any thoughts?
Yeah, I think now that the merge happened, you're going to see more and more institutions staking and entering the space. The risk is decreasing, the rewards increasing, in particular for Ethereum. And yeah, pretty much, if you were mentioning about Fidelity, right? So the largest asset manager in the space, Fidelity in the specific case, they supported ETH on their custody, and there's high chances that you can see these institutions to start staking from the balance sheet or offer staking to the customers in the next 12 months. That's what's happening today. And coming back to your questions earlier, Jim, I think you're right. It's a bit early for them to run their own validators, or the nodes. But you're going to see maybe 24 months, 36 months, these players to participate in the network themselves, because that's what financial institutions have been doing for the past 30 years, running their infra themselves. And I'm pretty sure we're going to see also emerging a lot more adoption of liquid staking token and liquid staking token from these institutions.
Fantastic. Andreas?
Yeah, maybe wrapping up, a question to the audience, because I think the audience doesn't quite reflect the institutional investor space. Who here is deliberately not staking their assets? See, 1, 2, a minority, right? It's 3, 4 in the whole audience. The rest probably happily stakes because our risk profile is different. I see in the next 12 months there are lots of things that are important for institutions where we see important developments. Regulation is very important. I mean, I don't want to know how much can go wrong if lawmakers make the wrong decisions. Every proof of stake asset is a security, for example, right? So we need better regulation, and you mentioned France before. Some countries are spearheading that. That will be different in 12 months. Insurance, when staking, slashing insurance especially, at the moment practically doesn't exist. There are ways to protect yourself, to hedge the risk, but there's no real insurance offering. I think that's going to change as well in the next 12 months. Liquid staking, I'm really excited about how that develops in the institutional space. And of course, it's a huge topic, and it's not really discussed in the institutional space so much, at least to my knowledge, MEV. I mean, what's going to happen with MEV and, problems emanating around MEV, like centralization and so on. I think the next 12 months are going to be really exciting, and the good news is it's a bear market, so we can enjoy all this. without all the hype and all the BS of a bull market, right? So,
fantastic. Thank you very much, folks. So it sounds like the general message is the institutions are coming. We're going to be ready for them. By the way, that means that next year you should already book your tickets for Staking Rewards early because it's going to be full of finance guys in here, okay? Thank you very much indeed for the panel.
Thank you.
Thank you.
I'm so fucking cute, bitch.